Today, the real story of mortgage stress. I thought it was worth just trying to unpack some of the latest data from our surveys because there is a lot going on, and a lot of the generic top-level information that's presented, these average house price moves and things, don't really get into the detail sufficient to be able to understand that granularity is key here. You need to go granular to understand what's going on. So what I'm proposing to do is to spend a little bit of time just sharing some of my research. This is in January, so the data is up till the end of December. In fact, it was including the first few days of January just because of where the weeks fell, but it is very current. It isn't just pre-Omicron, as it were. And we'll try and define stress correctly. That's really important, actually, because there's a lot of rubbish spoken about mortgage stress, and a lot of people are using the old rule of thumb of 30% of income or more means you're stressed. That's not helpful, right? So I look at stress in cash flow terms, money in, money out, how much are people having to spend on various things, and how much have they got left in terms of money left. If they've got money over, then they're not as stressed. If they've not got money over on a cash flow basis, then I put them in the stress bucket, and that can be true whether you've got a mortgage or whether you've got rent or whatever, right? Investor stress is slightly more complicated, but we'll come on to that. But the point I want to make is this is an accurate measure of household cash flow, so that's how I define stress. And that's much more appropriate than I think some of the generic material that's out there defining it different ways. I'll talk about the models and how we do what we do briefly. I'll look at some of the results. I'll also do some postcode stress mapping because, again, I want to highlight how important it is to go granular, and I'll show you some of the tools we use for that. And if we've got time, I might even get you to throw a postcode at me and I'll tell you what the information is in that postcode. And then I'll touch on the scenarios we use in terms of driving some of that analysis. So that's what we're going to do. Core market model is what we use to drive the research. 52,000 households on a rolling basis. 4,700 a month, actually, 52,000 in the model any time. And we ask a whole bunch of questions about their finances and their positioning, including, mortgage, rent, investments, all of those things. So it's quite rich. And that allows us then to drive a whole bunch of analysis out of a lot of different mechanisms, including to our blogs and to the YouTube channel and our mortgage stress reports. And we can slice and dice the data all sorts of different ways. And that's very important, again, to highlight the fact that you need to think more than just aggregate data to really understand what's going on. So we look at it by state, we look at it by different segments and other things, and I'll show you some of the data shortly. To give you an example, the average savings ratio across all households went up, still quite high. But there's more than 20% of households who have less than 1 month's savings available if they have an emergency, right? So that's an illustration of, the average masks a lot of differences. And we know that at the top end of town, a lot of people are doing quite well. The stock markets are up, property prices are higher. So they feel quite affluent, but there are others that are not. And that's why it's important to get really granular with some of this information rather than trying to just talk at aggregate levels. And by the way, if you're thinking of buying in a particular suburb, particular property, again, you have to go granular because there are some big differences, units versus houses, different areas as well. So all of those dimensions, I think, are really important. Okay, in terms of the model, one of the things we also do is to drive scenarios out the back of the model. So essentially, we don't try and predict the future. We just say, here are different numbers of different scenarios that could play out. Now, of course, you will know, quite often my scenarios get picked on, and one particular scenario then becomes the headline, a la Challenge 9 from a few years ago, but I actually run multiple scenarios, and that's quite deliberate because the uncertainty that's in the market at the moment is very high, and therefore no one can be definitive about precisely what happens. And I chuckle when I see all of the bank economists, one time say property prices are going up, 10%, and then a bit later, no, they're going down 20% or whatever. You cannot be definitive. You cannot be definitive. You need to understand the different scenarios and what's driving it. One of the things I'm very passionate about is uncertainty rather than certainty in some of this data. Now, if I then go into the stress, price trajectory data, the buying and selling intentions, the migration data, and the economic data down at the postcode level, bang it through the core market model and the scenarios, that allows us then to actually create some scenarios for a particular postcode. This is an out-of-date slide, but it gives you the point. So we can talk quite granularly about what may happen ahead based on all the dimensions that we're seeing. Okay? Now, mortgage stress, the first thing to say is that I'll start with mortgage stress, and this is to the end of December or just early January, as I said. So mortgage stress actually went up. So 41.8% of households are now registered in cash flow terms in mortgage stress. So that was up from last month. And you can see that there's been quite an acceleration before, pre-COVID, February 2020 at 32.9. It's been wandering higher, up and down a bit. Basically, when things open up, things get a bit easier. When things grind closed again, things get harder. 41.8%. That's a lot of households. There's a lot of moving parts, right? So firstly, incomes are still relatively flat for most people. In fact, the number of hours that people worked will be down again because of all the informal lockdowns, shall I put it, in a polite way, over, and we're seeing some of that. We also know that a lot of people got bigger mortgages. The average mortgage is, 10% bigger than it was pre-COVID, in some cases even more than that. First-time buyers, in some cases, up to 20% bigger. We know that some of the lenders were very generous through the latter half of last year in terms of their lending ratios. APRA sort of came in over the top and said, no, lift the buffers. So we're seeing some of that. And the cost of living is the other element, the other moving part, right? We know that cost of living has been moving up significantly. Childcare costs, for example, healthcare costs, food costs, fuel costs. So a lot of that's in there as well. So it's not just one thing, it's a multitude of different elements, all pulling in different directions, and it's the net sum of all those that gives us the answer that we get. The other point, of course, is that the Reserve Bank and APRA and the Treasury will know that even small rate rises will have a devastating effect on households' finances here, because our leverage ratios, if you look at the amount of leverage in the system, is much higher. And in fact, I might just make the point. This is actually the RBA's latest data, which shows that the household debt ratio has gone up again to 184.6, which is, by the way, a lot higher than in the US. But remember, that data is mistaken because it's only 1/3 of people who have a mortgage. So you need to multiply that by 3. And that data also includes SMEs as well. So once you take that out of it, the average household debt ratio is about 6 times in Australia. And what that basically means is there's almost no capacity for people to handle higher rates. Another reason why I think the Reserve Bank is likely to sit on its hands a lot longer than many people think, unless the exchange rate really goes way off. But I think the RBA will also be quite happy with a weaker exchange rate, because that will actually help them. Now, this is the overall data. Now, this is by state. And the way to read this is you go down the page in each state, number of households, and then how many of those are in mortgage stress, rental stress, investor stress, and financial stress. And then I calculate the movements. And basically, if they're yellow, that means they've gone up compared with last month. So you can see there that South Australia, Tasmania, Victoria, Western Australia, and the total are also all up 41.79%. And that equates in mortgage stress terms to 1.5 million households. The total household count there is 9.55 million. It's moving up and down a little bit as people move around the place. I noticed some drifts from Victoria to from Victoria to Queensland, for example. So Queensland is growing. And you can see there that Tasmania has an enviable 50% of people in stress, mortgage stress, but it's also gone up a bit in WA. There was a little bit of a flash in the pan in WA, but prices there have eased out a little bit. But it was a little bit lower in ACT, New South Wales, NT and Queensland, and that is really to do with the fact that earlier on there was a bit of reopening, a few more hours worked. If you look at rental stress, different story. Rental stress is up in New South Wales and in Queensland, lower in some of the other states. If you look at investor stress, so these are people with property investment, and basically if they don't have those let, or if they've got a rental stream that's in negative territory, or they're trying to sell, or those sorts of things, then I put them in the investor stress category. So in New South Wales, 1/3 of property investors are struggling, and in Queensland, 24% are struggling. And just to finish the story, the aggregate level of financial stress, which is effectively a weighted sum of the investor, rental and mortgage stress, shows it's gone up in New South Wales, it's gone up in Victoria, and it's gone up in Western Australia, and the total is 40% of households. So there is a lot of issues there. 4 million people basically have financial pressures across the Australian population, right? That's a worryingly high number. And again, it's not really one that's well publicised in a lot of the information that is out there, but it's very important to understand. There's no safety net this time around, and banks haven't sort of announced more mortgage holiday repayments and those sorts of things, which they did last time. So yeah, I also think that you've got to bear in mind the SME sector. The SME sector is being buried in a number of areas simply because they were expecting to be trading through Christmas, New Year, if you're in hospitality, retail, etc., etc. That's where the really pointy bit of this is. Quite a few of those people with difficulty are in those sectors. The SME support, again, is pretty laughable this time around. If you go back to, the first phase of JobSeeker, a lot of that went to the big end of town, those billions and billions of taxpayer dollars, never needed probably to do that. Didn't go to the right areas there. Not going to the right areas now, and there are a lot of people, I think, in some significant difficulty. Of course, we don't know what's going to be ahead. Is this a short, sharp correction? It might be okay, but if it goes on for a bit, the cumulative effect, and that's what I keep coming back to. Remember, I said 32% of households before COVID, 41% now. That's 10% more people caught. That potentially has a long-term implication for those households and their financial plans and a whole bunch of other things. And again, I make the point that if you start mapping savings to stress, what you discover is that those who are not in stress have big savings. Those who are in significant stress don't have big savings. So again, it's very asymmetric in terms of the distribution of those savings. Well, basically, it's a cash flow problem. So, if you're trying to make your mortgage repayment, most people will prioritise the mortgage repayment above other things, even if it means going without meals, if it means pulling money out of credit cards or raiding savings if you've got them to make your ends meet. It means prioritising a bunch of things that you perhaps would prefer to do. In my surveys, I see people who, for example, should have gone to the dentist, but they chose not to go to the dentist because they had a mortgage to pay. It's those horrible situations where you have to prioritise what you spend your money on. Is it the kids' clothes, or is it the next meal, or is it the mortgage repayment? In those sorts of situations, that's really the pointy end of it. And the point is here, this isn't something that trips somebody up just on one month, right? It's the month in, month out, year in, year out grind of trying to balance all of the things that you can't balance. And interestingly, in my surveys, we actually ask them whether they feel that they've got a financial stress issue. And then we do the analysis based on the data. And almost always, households are more confident about their financial position than actually my analysis suggests that they should be. So there's a gap in people's expectations versus what's really going on, head in the sand type thing. The other point is only about half of households actually ever run any sort of cash flow. So they actually don't know what money's coming in, what money's going out, where it's going. So one of the things I always tend to say to people is make a cash flow, start prioritising where you're spending your money, because maybe you should give up some of those online subscription services and focus more on other things. It's a priority question quite often. But this can get into terrible pain because this grinds on and on and on, and eventually gets to the point where people have to refinance, which is not necessarily good because it means they have to pull more equity out, which means they have to have a bigger mortgage potentially later, or they actually end up ultimately deciding to sell their property. And those are the sorts of forced sales that aren't in any forced sale numbers anyway, right? Because it's not a forced sale driven by the bank directly. But quite often, quite a few of the banks will be whispering in people's ears saying, hey, your circumstances have changed, probably worth putting your property on the market. So that's how this mortgage stress story ultimately plays out. It doesn't lead to default directly, but it leads to this financial pressure, which can lead to relationship issues and a bunch of other things too, as well as the question of, well, can you stay there? Can you afford to stay there? And if not, what do you do? So the psychological aspects, the health aspects, and the financial aspects all come together, which is why this is a big deal. And incidentally, where there is high stress, you often also see high crime rates as well. So there are some real social implications of all of this. So there are people who basically say, look, debt is just part of, it's wired into the way that I run my affairs. I will always have debt. I'll have debt until I die. I don't really intend to pay any of it down. I'll just go on paying, month in, month out, et cetera, right? In other words, you are a cash flow, and that's all the banks really want. As long as you go on paying, doesn't, no skin off their nose. So a lot of people will adopt that position. Unfortunately, of course, it means you end up paying a lot more back to the banks than ever. But debt is sold as an easy solution to financial pressures. I worry about that. I think of some of the buy now, pay later solutions, some of the high interest rate credit cards, payday loans, all those sorts of things. A lot of people, particularly those under stress, end up grabbing more debt. And if I talk to financial counsellors, quite often what they say is that the real problem is that you end up with this sort of accumulation of debt that just gets to the point where it's unmanageable. And that unmanageable debt is then a nightmare to try and deal with unless you can actually get some specific help. So there will be a number of people who will just say, yeah, fine, no, debt's no problem, I'll just go on paying it. And of course, then the question comes, okay, but what happens if interest rates do go up? Will you still be able to pay it? And look, the question, the whole concept of the wealth effect, which is, house prices go up, people feel more affluent, so they go out and buy stuff, right? I mean, that's what the government has been running for at least a generation, right? The question is that morally sustainable, but is it also economically sustainable? Because I give you a counter argument. If you are paying a larger proportion of your income supporting mortgages and other forms of debt, then actually, ultimately, you're going to have less capacity to spend. You might have brought some of it forward, but essentially, if you think of it over the medium term, actually the right answer is to reduce the reliance of mortgage repayments and reduce the amount of mortgage debt, because then people have more discretionary and disposable income to do other things. That could give you a much better longer-term outcome for the economy. But that's not where we've gone. What we've gone is basically an economy that's driven fundamentally by mortgage debt and fundamentally by ultra-high house prices. That's inflated the banks' balance sheets, and they're doing well. The banks' investors are doing pretty well. But the question is it actually good for those households? And what I come back to is going back granular. There are some that are fine with this and high levels of debt. And okay, if you make that decision and you make it consciously, fine. But if there are people who actually have got into it almost by accident and then scratch their head thinking, this doesn't feel right, but I don't understand why I'm where I am and what do I need to do about it, they're the people that I want to inform, right? And basically I want to say, look, debt is a choice, right? You can choose to play that game and you can choose to support the bank's profits. That's fine, and banks will love you for it. But sensibly, is that the right strategy? Or is there actually a point where you say, well, debt helps me get into a particular position, it might help me buy my first property, but then what I want to do is to pay the debt down. Because it's interesting that if you go back 15, 20 years, mortgage brokers would talk to people about how they can pay their mortgage down quick by paying more than the minimum. Right? And some still do that today. But these days, the conversation is, well, we can give you a 35-year loan, you can go interest only, and that will keep your payments as low as possible for as long as possible. That is a different moral argument, which I'm quite concerned about. And we run sensitivities on that, scenarios where rates go up by half, 1, 2, 3, 4%. And it's very interesting just watching the way that plays out, because there are various tipping points where suddenly people find that, they can't afford it anymore, and then they've got to make some decisions about what they do. The point again I want to just make, that we are so leveraged relative to other countries into our property sector, right? That we've got a property sector that's too big to fail. We've actually got a banking system that's completely wired to the property sector. So, the banks can't be allowed to fail, which means that property can't be allowed to fail, which means you've got to keep property prices up, which means you've got to get people to pay ever more in the way of terms of mortgages. And the question then is that a sensible strategic position for an economy as we go into the next decade or not? And, that's, if you like, the philosophical question that I come back to, and I'm troubled by it. I think we're actually digging a hole for ourselves. And this is actually the segmented view. Remember I mentioned segments? So these are different segments, and I won't go into them in detail, but it's worth noting that if you look at young growing families, that includes a lot of first-time buyers, 76% of them are actually in mortgage stress. That's a very, very high number. That's a big issue, right? And you've also got people on the edge of town, the battling urban, the disadvantaged fringe. These are in these new estates, the high-growth corridors, as I call them, like places like Narrow Warren in Victoria, for example, Liverpool, Campbelltown, those areas, where effectively you've got a lot of new properties being built alongside existing property. A lot of them are highly mortgaged. So that is where the real pain points are in terms of just the relative numbers. But then if you look at the rental stress, it's a different group. So you've got this multicultural establishment, that first-generation Australians. 54% of them have issues. So these are first-generation Australians struggling to make repayments. The young affluents, so these are a lot of people, for example, living in Bondi with big mortgages, A lot of them are struggling at the moment. And then you've got the more mature, stable families. Again, a lot of those are highly leveraged. A lot of them have multiple properties or big properties and big mortgages. So you can see some of the pain that is there. Then if you go to investors, different story again. Young affluents, once again, more than 50% are struggling. And that's because a lot of them have bought high-rise apartments and are highly leveraged into them. But also exclusive professionals. So this is the top end of the market, the most affluent households, highly leveraged, got multiple investment properties. Quite often some of those are not performing very well either. So again, you can see how it varies by different segments for different types of investments, as it were. And then financial stress overall, while the battling urban, the young affluents, and the young growing families are all where a lot of the action is. So it shows you that different groups are really differentially impacted by all of this. These are the top postcodes with mortgage stress, but I'm using the count of households just to give you a relative comparison. So WA 6065, which includes Wangaroo and a few places like that, are right up the list. Then we've got Chipping Norton, that's one of those high growth areas around Liverpool. Then we've got Toowoomba, out west of Brisbane. Narre Warren, another high growth area in Victoria, Berwick and Halfway. Ferntree Gully and places like that. And then out to Ballarat. So you can see quite a few Victorian postcodes there, over to Western Australia, then more Victorian postcodes. You can see how a lot of these are actually, similar. It's like Point Cook, Werribee, very significant footprint of risk. And high growth is what you're seeing there predominantly. So there's two parts of the question. The first question is, okay, so you got a home builder home and land package, whoopee, you got your $80,000 or $50,000 or whatever it was. Unfortunately, now it's taking 2 years rather than 1 year to build, and if you can find a builder, and the cost of materials have gone up 30%. So quite a few of those households are caught, and they're now trying to make decisions of whether they will complete or whether they won't complete. You're right, they also quite often have rental, or in fact quite often go back to live with parents while they are building the property. So suddenly the parents are now stuck with their kids for 2 years rather than 1 year, right? That tends to be the scenario that's playing out. The other point, of course, is that the stage payments on a new homeland package is quite complex in terms of, well, when do you pay what, and if in fact you're paying a lot more and the value of the property isn't necessarily behaving the way that you expected, you can quite often end up with a mortgage that's a lot bigger than what you thought it was going to be. And that's the other factor that's coming in. Final point, of course, with some of these new properties, once you move in, it's no longer new. And typically what we see is a 15% drop in the price, because just down the road, they're building a whole lot of new homeland packages, and those are actually more attractive. So you've also got this other crunch of what the value of the property actually is, and that's something else that's captured in my data but not necessarily fully represented in the stress data. So it's a really complicated picture. What I would say to people is that if you've done the sums on a homeland package, worth checking the sums now, because as I say, costs of construction are rising, the term over which it's going to be built is going to be extended, and you may end up with a different financial position than what you thought you were going to be in. And we did mortgage stress. Why don't we just look at rental stress, because that's quite an interesting story too. So this is Toowoomba at the top, Chipping Norton, and then the New South Wales, around Roose Hill and places like that. And then we go to Bidwell and places like that. Notice also that we are starting to see, for example, Gosford, places like that, right, the Central Coast. That's a particular hotspot for rental stress at the moment, as well as Wentworthville and Westmead in Western Sydney. So you can see here that quite a few of those. Bondi's on the list there as well. Wollongong is on the list because of the fact that people are actually having to pay quite a lot more. Darlinghurst. So a lot of New South Wales. Also worth noting that Pacific Pines up in Queensland is on the list too. So one of the things I've noticed is some of the changes in the rental market in those coastal strips in Queensland. So that's something else to watch. So one of the factors we're seeing with that is that people have found their rents have suddenly gone up. So there were these rent protection periods, particularly through COVID. They've finished, so investors have tried to put the rent up. People have suddenly found they can't afford it, so they've got to move somewhere else. Quite often they're going to cheaper areas and getting perhaps a less good property. So that's part of what we're seeing here. The other factor is that, again, rent reviews are now back in vogue, so more people are actually finding their rents are going up, and investors are trying to claw back some of the stuff. And the other question is, what happened? You know, those rental holidays? Well, were they holidays or were they just deferments? Right? And we're seeing quite a few people in our surveys who still owe back rent, right? Because it was never actually a holiday, it was just a deferment. And so they're still behind with the rent because of that. And that's another factor that's in the mix too. It varies again by particular postcode. And the final point about Queensland is, of course, there's a lot of interest to move up to Queensland and a lot of holiday apartments and stuff up there. Rents are quite high up there now as a result of that. And that's putting more pressure on locals in terms of renting as well. What I'd say is that we've had a huge stimulus from both the government and from the Reserve Bank, and we've seen the impact of that. I think the tide is going out. I don't think the tide has gone right out at the moment. There is still quite a lot of savings in the system. A lot of people have been able to save for quite some time, and the last boom of property is still sort of having a bit of echo on what people feel at the moment. I think, ask me again in 6 months or 12 months, I think then we'll see where we really are. But funnily enough, that's after the next election. Well, clearly, ScoMo will say property prices will be higher under our government than the other guys, right? He did that last time, and it proved to be the case. Well, if you drop interest rates, what do you expect? Housing affordability has been morphed into a supply-side issue, which happens to be a state issue. So the federal government can say it's nothing to do with us. The Reserve Bank and APRA say house prices have nothing to do with us. So everybody can point to somebody else and say it's not my problem. The problem is nobody really wants to address the elephant in the room, which is that housing is unaffordable, mortgages are too big, households are under pressure. And frankly, both sides of politics seem to me to be dancing the same tune here. So I'm not sure necessarily that from the major parties you're going to get anything useful in terms of the election. Some of the minor parties probably will come out with more distinctive policies. Whether they have any chance of actually being effective is a different question. But, bear in mind also that this housing thing is not just an Australian thing. New Zealand's got it, the UK's got it, the US has got it. It's part of the fallout from quantitative easing, too much money printing and too easy monetary conditions. If those are wound back, then whatever side of politics is in power ahead are going to have a major issue. And I don't think we're going to see another 22% property price rise over the next 12 months. The question is, will it fall? And by the way, I've got some data which I'll share in a second in terms of, because I'm actually starting to analyse this now by the political parties, which is quite interesting. So I might touch on that towards the end as well. Just briefly on investors, this is Queensland, Surrey Hills, Mandurah. Mandurah is in my top 3 quite often in Western Australia. A lot of people deeply in negative equity from property investors over there. That's because you've got to go back 10 years, right? If you look at 10 years, property prices were higher in Perth then than they are now, right? So you've had a minor correction up, and of course everybody in Perth was saying, yay, property prices are going to go through the roof. No, they didn't. They've actually moved up slightly, and they've gone sideways. Now, there are a few postcodes, a few houses that have done very well, but a lot haven't, a lot of investment properties. And of course, you've got this flood of home builder stuff, so a lot of new home land packages coming in, so the supply is quite high. And you've also got little interstate demand because the borders are shut. And the international borders are shut. So, yeah, the properties market in Perth is still bouncing along the bottom. And talking about Mandurah, people who bought in 2016 and 17 are way underwater still from when they bought then, right? So it's a long-term problem. In fact, if you go back to 2010, prices were higher. But if, in fact, you are 30% under value, negative equity, as you are in Perth still, in Mandurah, say, doesn't make much difference. You're still stuck. You're still stuck with the investment problem that's not performing, no capital growth, and no real returns. You've got a major issue, major headache. So, yeah. Then we've got Melbourne, central Melbourne and South Yarra, right? And that goes back to those high-rise. That's the high-rise problem from stressed investors. And then it goes on St Kilda, for example, Chatswood in Sydney, and a few other places too. So you can see there that some of the more affluent areas, like Lane Cove, are also on the list too. And that's a combination of the types of property and the types of households. Okay, let me just show you this slide. This is where I took each of the parties. This is based on the last federal election, and then I looked at the proportion of households. This is basically who was elected in each of the locations. And interestingly, 48% of households are ALP'd. But 53% are in mortgage stress. Sorry about the dogs. Total rental stress is also higher than average, so you can see that there's an interesting story there. Whereas if you look at the Liberals, 31.8% of property investors compared with 29% of households. 33% are stressed property investors compared with 29%. So in other words, the Liberal Party should be actually putting up a policy to protect property investors if they want to gain more voters, whereas the ALP should be dealing with mortgage stress and rental stress if they want to deal with it. So it's an interesting, it's very draft, it's very early, I'll probably do more work on it, but I thought it was quite an interesting slide. Both major parties are coming closer and closer on housing, it seems to me. There's very little differentiation between the two of them. Both of them are following similar paths, both of them looking to be more interventionist, potentially, attract first-time buyers, bribe first-time buyers into the market, all of those things. Neither of those big parties want to deal with the fundamental structural issue that this represents, and that for me is a big problem. When you look at the small parties, you probably can't resolve too much, but I'm going to do some more work on this. I think I'm going to actually break it down to individual locations and regions and have a look at what the political cuts of these various trends are, because it looks to me as though there's a really important story here, and we'll be tracking that around the election. Now let me just then switch across and talk to you about the stress mapping, seeing as I got the stress maps up. Just to explain, the maps here are a way of just trying to show you in visual form where the mortgage stress is, and we use the same colour coding. This is actually based on Sydney at the moment, and the bluey colours are the lowest stress. We go up to the yellow and the orange and the red, and more than 9,000 is the highest. And you can see as we pull out from the Sydney area, I'll just move that across slightly. I can just do that. Where are we? There we go, there, yep. And you can see there that we've got a real pocket in and around Liverpool, that sort of area, Western Sydney. The fact is that Western Sydney continues to be a significant issue. You saw it in the individual examples, but this is also the broader map. And as you pull out further, you can see the same old, with places like Campbelltown and Liverpool and Fairfield. But, there's a few interesting areas there, but this Western Sydney swathe is where a lot of the issues are. If I then go to Victoria, so let's put in 3,000. Okay, just go there. Okay, and again, sort of pull out a bit the same fashion. You can see that in the centre of Melbourne, mortgage stress is not too bad, but as you pull out, you can see that you get some of those outer lying areas, some of the new development suburbs is where a lot of the issues are. And as you pull out further, you see over here towards the west, it's definitely a significant amount of that. So, the old Point Cook, in the Wyndham area, those sorts of areas like that. And if you look then further out here, you find out towards Dandenong and places there as well. And if you pull out further, you can see that there are very significant differences in different parts of the location. And then we have Ballarat also showing significant pressures too. Now I will just do one more. Let's go to 4,000 for this one. Go to Brisbane. I guess the point I'm trying to make here is that you have to go granular really to understand precisely how this is all working. And again, as I pull out from 4,000 in the centre of Brisbane, you can see that close in, stress isn't too bad at all, but as you pull out, you start to see one or two areas where there's more pressure on households. And indeed, as you pull out towards the west, or indeed even for south and north of Brisbane, you start to see somewhat higher levels, although generally the overall levels of stress in and around Brisbane are not necessarily as significant as they are in some other areas, but here you have the old Toowoomba, Ipswich and those sorts of areas where there is definitely more stuff going on. Now, let me then just quickly go to rental stress and just switch across to there. So again, I'm showing the same data now, but this is actually now rental stress. Again, I'm starting in Sydney, and you can see there that rental stress is a significant pressure in and around areas of Sydney. And some of those in the centre of town, that's a lot of high-rise apartments, a lot of issues there, of course. But as you go out west, again, you start seeing the same old problems. And it's also worth highlighting that even in sort of the Bondi area and around there and around Woollahra, there's a few issues too, beyond Parramatta. And again, as you pull out, you start to see those areas where there are stress areas. Central Coast is a real issue. We've got issues in the Canterbury area and Parramatta and beyond, over towards Blacktown. And as you pull further out again, you can see the same at Campbelltown is a bit of an issue too. So it shows you again that this rental stress, it sort of mirrors quite a lot of the pressure on mortgages, but with slight differences and different types of households, of course, as well. This is now Victoria, and again, I'm just showing you the same sort of trends, as big as I can. And again, as you pull out, you start to see some of the pressures. And interestingly, some of the pressures are somewhat similar, but closer in. So you can see here in areas of Melbourne, closer into Melbourne, there are areas where there are difficulties. As you pull out again, you can see the same representation. And again, in the Wyndham and surrounding areas, there are significant issues down in Dandenong. So there is a bit of a mirroring. If I go to Perth, just to give you a little bit of an alternative example, because I can. I'll come back and read the comments in just a moment or two. Let me just finish what I'm doing here first. Okay, so this is now pulling out from Perth, and remember I'm looking at rental stress here, so this is looking at where the pressure is. And what we also find is that as you go out from Perth, you start to see some pressure north and south of Perth itself. It's not too bad, but there are areas nevertheless, particularly on the coastal fringe, where there are areas, and it's a bit more extended out towards Rockingham and north of Perth too. And I will just briefly switch to my other one, which is the investor stress map. I have these available, and there I'm looking at again Sydney 2000. So not surprisingly, with the rental stress, we're also seeing property investors who own property in the centre of Sydney struggling, definitely struggling at the moment. These are property investors. We see also places like Lane Cove where there are issues. Mossman, there are some issues as well. And in fact, if you look out towards Strathfield, you've got issues there. Some down towards Randwick as well. So you can see these hotspots where in fact there's a pressure on investors. A lot of it's high rise again. And as you go further out, you can see Western Sydney is also registering. The Northern Beaches is also registering as well. So there are significant areas. Now, I'll make the point, if you look at the listings for high rise, there are significant numbers of listings in some of these hotspots. So there are now property investors who are definitely desperate to try and get out. And I'm seeing that in my surveys too. If I go to Melbourne, just to show you that too, it's a somewhat similar point where again in the centre of Victoria, 3000, 3006, same issue, pressure on high rise particularly. And so a lot of property investors are in some difficulty trying to work out what to do. Should they sell? Should they not sell? Should they try and let at a lower rental? Or should they just try and walk away? So it's very important to understand that this stress is very much the mirror image of the rental stress I showed you earlier on. And it's interesting that if you come out further, if you go to places like Frankston and Casey, there's hotspots there as well. And in some regional areas, you see the odd hotspot too. But a lot of it is in and around the centre of Melbourne. Just to sort of give you another picture, this is actually my modelling data. It happens to be Wollongong, But what I then do is I take all the information in terms of households and everything else and the maps, and I then make some projections based on where unit prices might be going and where house prices may be going over the next 3 years, based on my scenarios, based on the data. And that's when you get the granularity. So it's important to understand that actually there's considerable variation between different locations. You have to go granular really to look at that. And I do that for all postcodes, right? So that's sort of and then the final point of the point is, if you want to then say, well, how things are going to play out, my scenarios, my RBA baseline is, I think, in the next 2 or 3 years, we might have a rate of 1.5%, and we might see house prices go up 5 or down 15, somewhere in that range, depending on units versus apartments. I give that a 10% weighting. But my best case, this is the one that I think is most likely to happen with the 50% weighting, is that rates probably won't be more than about 1% over the next couple of years. Unemployment rate will be about 4.8. Mortgage stress will be down a bit from where it is, but not dramatically so. And there is a small chance of an uplift, but a stronger downlift for house prices, and 50% weighting. But then if you want to say, well, if we get more crunches, be it financial crunch or a COVID crunch, then there's more downside. So that's sort of the way that my scenarios then drive into my modelling, which then drives into those specific examples at a particular postcode level to then look at what's really going on. And that gets updated every month when I do the work. This is a complex interaction of multiple elements, right? And in fact, if you talk to people about when they make buy decisions or investment decisions, often they're not taking decisions based on the full range of information, right? They're being very tactical or very one-sided. So people say property prices always double every 7 years regardless, right? Well, if you believe that, then you'll do one thing. Whereas if you actually do the work and understand what the real risks and returns are and what the real net yields are on investment properties, you might make a different set of decisions. I guess what I'm advocating for is more granular analysis and more informed analysis by people when they actually go make property decisions. I'm not against property. I own a property, and it's absolutely fine. But you got to make sure it's the right property in the right location with the right financial background, and you've done the work to be able to actually figure out whether it is the right thing. Don't just get sucked into the Ponzi scheme that everybody else seems to think, where property you can only ever win. I know from my conversation with a lot of different people that sometimes you are winners, sometimes you are losers, and unfortunately there are property areas where prices are still way down. For example, North Ryde apartments down more than 20% from where they were in 2017, even now. So it's not always a natural winner. And the point of properties are liquid, right? So you have a theoretical profit if values go up, but until you actually come to sell, you don't know whether that profit's real or not. And it's worth reminding people, property prices do sometimes go down as well as up. Is property of investment, or is it actually for somewhere to live, right? And I've always believed that we've financialized property to the point where it's become an asset class, just like stocks and shares. I think it's qualitatively and quantitatively different, right? So I would be thinking about it more as a place to live and all those sorts of things. And if you get a bit of growth on the way, good. But frankly, expecting another 22 to 25% growth of property values over the next year, it's not going to happen. So, that was a one-off set of things because of low interest rates and because of government policy and quantitative easing and all of that sort of stuff. We are now in a completely different world, and with rates going up, I think the future prospect for property is much, much more suspect. Again, there will be some that will do very well, but you've got to pick your winners, and it's really, really more important than ever before to do the work and make sure that you've done the right analysis to be able to actually come to the right decision, rather than just jumping in with 2 feet and saying, oh, it'll be fine because it's property.